This is Austin Fitch from Horizon Investments. Hope everybody is doing well. Really appreciate everybody joining us this afternoon and maybe this morning for some of you out on the West Coast. Really looking forward to diving in today to a review of Q4 from 2019, but also a look forward into 2020. I am privileged this morning to have Mr. Scott Ladner, our Chief Investment Officer, sitting here with me. So we will definitely draw upon his expertise as we get into the deck that we've got prepared today. But first and foremost, really, again, want to thank everybody for joining, but also want to thank everyone for their partnership in 2019. It was a great year for Horizon. I think it was a great year for most all of our clients and firms that were partnered with, and really just looking forward to a strong 2020. So with that being said, we'll dive right in and we'll kick it off with a review of 2019. We'll get into some of the conversation around whether or not we are late cycle. We'll talk about the U.S. consumer. That's a piece that we think is getting massively overlooked. And then finally, we'll talk about a few things that are maybe keeping us up at night, maybe what we're watching for in 2020. Before we get into the slides too much, I'll also remind everyone that through the GoToWebinar functionality, you do have the ability to type in questions there on the bar along the right-hand side. We would love to take any and all questions that you have. Feel free to type those in. And we'll answer them either as we go through the deck, or we'll definitely take time at the end to address any questions that have come in. So with that being said, we'll get into the meat of today's deck. And this first chart shouldn't be surprising to anybody. It's really just a chart of asset class returns, highlighting both the fourth quarter, but then also 2019 as a whole. And I think what you'll note is the strength that we experienced in the fourth quarter, with equity markets in some cases up double digits, only added to the strength of the overall year. You had the S&P up more than 30% last year. Obviously a banner year for equities, coming off the back of obviously a very volatile fourth quarter in 2018. But you had a very strong year really across the board, both on the equity and even the fixed income side. So with that baseline being set, maybe Scott, I'll turn it over to you, and let's talk about just how the investor has reacted to that rally and what we've been seeing maybe more recently.
Yeah, hey, thanks, Austin, and hello everyone. Thanks for joining again today. Look, the investor positioning is one thing that we certainly take a look at and analyze a lot, both on the retail side and on the professional side, because just to get a sense of when and if there's ever crowding into a particular space, into an asset class, or into the market more broadly. The dynamic coming into October was stark, and it was stark from this standpoint. Fund manager positioning. So the BAML has a fund manager survey that they conduct, a couple thousand folks like us that submit to it. Essentially, professional fund managers were the most bearish positioning that they have been since October of 2008. And so, in terms of like fund manager positioning, it was horrible. It was really, really bearish. Very defensive, high on cash, high on utilities, high on staples, high on bonds. Like just hated anything having to do with equities or Europe or anything, or just broadly risk stuff. The fund managers coming into October were really offsides from the bearish standpoint, and that was mimicked by very bearish positioning and by retail investors. The orange line in this graph is a measure of retail investor sentiment. Something that TD Ameritrade puts out, and based on some of their proprietary data. And long story short, when it's going up, retail guys like the market. When it's going down, they hate the market. And you can see this, for the majority of 2019, retail people really did not participate. They pretty much hated this market. And just in the last month or so, they started to get back on board again. So coming into 2018, we had super bearish positioning from both the retail and the professional sentiment side. And as we're coming into 2020, I'll tell you that the pro side has at least squared itself, so it's not over exuberant, it's just kind of normal now. But the retail bid is just starting to come back into this market.
But, and Scott, that's really interesting, right? To think about the fact that the retail investor has has maybe missed out or did miss out the first part of 2019, especially as we get into the conversation. And I'm sure everyone that's with us today has heard the conversation about the economy or us being in a late cycle. So the fact that the investor may have missed a portion of that run or a lot of that run is pretty interesting. I think these two charts that we're looking at here, I would say most of you have seen some version of this. Chart on the left just looks at the length of the economic expansion. This chart is put out by JP Morgan. So they define it as coming off the bottom, in this case, March of 2009. So you're looking at over 10 full years in the current expansion, which, as you can see, is the longest per this measure really since the 1900s. And the other piece that you see is just the strength of that economic expansion. And what you'll note is, while it may be the longest, it would also really show as the weakest, just in terms of pace of growth. And I think both of those are interesting data points and ones that have been used, I would say, by the media to suggest this idea of late cycle. Again, talking more to the time argument really than any sort of data argument. And Scott, I would say that we maybe have a different view of things. Would that be a fair way to put it?
Yeah, I mean, we certainly think that this is an argument I've been making for months now, that this is not a late cycle economy, and this is more, this might be a much longer cycle than people are used to, and that is longer. We have these kind of interim mini dips and mini rallies, but at the end of the day, we're still sort of mid cycle. This is not a late cycle kind of thing, but that's not how the market traded for most of this year. For most of this year, the late cycle, early recession baskets, and I'll talk about how these things are constructed here in a second, but just know that for the first 3 quarters of this year, basically the late cycle sorts of stocks outperformed. But that turned sharply in the fourth quarter as it became apparent that we're going to get a trade deal done in China, as it became apparent that Brexit was going to be resolved in a pro-growth manner, as it became apparent that some of these other, that the PMI is coming off the floor, that stimulus was starting to work, we had accommodative central bank policy. All this stuff made it very apparent that we were not going into recession, neither in the U.S. nor globally, and that led to an outperformance of more mid-cycle kind of stocks, more mid-cycle kind of investments. And so what this chart is showing is an analysis that Barclays actually puts together that says, going back through history with the hindsight of benefit of hindsight, what stocks would I wanted to own if I knew for certain what part of the economic cycle I was in. And so that's what these different lines are representing. It's like the stocks that you would have wanted to own if you knew, for instance, that you were mid-cycle, or you knew that you were early expansion, or you knew that you were early recession. And as I said earlier, that the first 3 quarters are really dominated by that the late expansion / early recession types of baskets. But the fourth quarter came, and all these pro-growth initiatives kind of started kicking in and really being recognized, and mid-cycle stocks dominated. Mid-cycle stuff really started taking off. And we've seen a continuation of that thus far this year.
Yeah, I think that's a great point, Scott. And what I would also say is the time argument piece, and we'll touch a little bit more on maybe why we don't think that's as important. But the time argument, we would make the case, even if you're looking at that from that perspective, that it's been so long, it's been, whether it be 7 years or 10 years, depending on how you measure it, really you could actually make the case, even with the time argument, that we still are really only mid-cycle. So this chart that we're looking at right here gives you a good idea of, historically, there's actually precedent for much longer lasting bull markets. This chart goes back 75 years on the S&P 500 with the idea that you've had times of 17 and 20 years where the markets are basically going up and to the right. And again, that doesn't suggest that there aren't any pullbacks during that period. But what you'll note is there are significant periods of time when markets can run, and to suggest that just because it's been 7 years or it's been 10 years, it doesn't necessarily mean that we're due for a correction to the extent of a recession. I think what is also important as part of this is really to know that you have to look at the data, and this is where we'll get into kind of our perspective from a Horizon standpoint around why we think maybe as Scott just pointed out, we're maybe more mid-cycle than we are late cycle. I think the first thing to do, Scott, would be to look at the consumer and see, what are they telling us?
Yeah, and this is something that I think is really underappreciated, both in the financial press and just more broadly, is what does the U.S. consumer look like? one of the reasons why we avoided, it wasn't even close, but we clearly avoided a recession in the United States was because amidst a manufacturing slowdown, we did experience a manufacturing slowdown this past year, but we didn't get close to a recession because the consumer, which is 60-70% of the economy, is still in a fantastic shape. Here's part of the reason. If you look at household finances, so these are different. So the blue, green, and red lines are basically household debt relative to some measure, some aggregate measure. So relative to disposable income, or relative to GDP, relative to personal income, kind of however you want to cut it up. It's just debt relative to some kind of stock measure of how big the economy is. And what's fairly clear is that since the financial crisis, the U.S. consumer has been delevering. And so we had, the story is, for the first decade of this century was the consumer, levering up. The last decade has been the consumer delevering and continuing to delever. That's not the type of behavior you tend to find in late cycle economies. But the more important chart, actually, the more important line on this graph is actually the black one. The black one shows the debt service. So how much does it cost to carry my debt load, all my student loans and auto loans and mortgages and so on and so forth. And what you can see that's obviously a combination of debt level and interest rates. Well, we all know where interest rates are, and we've seen the story of delevering here over the last decade. The debt service for the U.S. household is really, really affordable. I mean, people are feeling really good about their own personal financial situation because it's objectively good.
So Scott, knowing kind of what the consumer's feeling like and some of the data that we just talked about, I think these are two really interesting charts in terms of trends that maybe run counter to what you would otherwise expect to see. I think this idea of savings rates, and we just talked about debt service, but these two charts give us a picture of where things have been historically during expansions and maybe how things have deteriorated versus where we sit right now. Is that fair?
Yeah, look, it's just it's human nature. Like, this is a chart showing human nature. When things are going well, you tend to project that they're going to continue to go well. So you lever up your own personal balance sheet. You buy that little bit nicer car. You buy the bigger house. You buy the second vacation home. You do whatever. But at the end of the day, like, what you do, you start taking on additional debt, and your savings rate goes down. That's the typical consumer response to an ongoing expansion. It just makes too much dang sense not to be that way. Well, it hasn't been that way this time. This time around, as you might suspect, given the prior chart, household saving rates has actually been going up during the entirety of this expansion, pretty much, and debt service has actually been going down, somewhat as a function of interest rates, but also as a function of the fact that people are still paying down debt. They're not comfortable with as much debt as they used to have, and so I would just argue that a higher savings rate or an increasing savings rate and a decreasing debt service load are not consistent with a late cycle type of economy or a late cycle type of story. It's just not the type of macro consumer behavior you see at the end of a cycle. We're just not close yet.
Well, and I think you point out the fact that this is not what you would expect to see, but I think one thing that maybe is it's a great sign in addition to what we just talked about is the consumer confidence side of things.
Yeah, I mean, this is another thing that, again, I just don't think people understand. Like you might feel it, you might think it, but it's just not in the data. And so Bloomberg, and prior to Bloomberg, there was another firm that did a weekly survey of U.S. consumers, 1,000 consumers. Just make a phone call and they ask 3 questions. They say, how do you feel about your own personal finances? How do you feel about the national economy? And is this a good time to make a big ticket purchase, like buying a car or a second home or something like that? And they just they collect those answers and they make a number out of it. The point is not where these numbers actually are. The point to this chart is to say U.S. consumers feel as good as they did in the late 90s. They feel that good, which by the way was a pretty good time. They feel that good, but their debt service levels and the way their job market is actually even better than back then. It's a much broader economy now, much more resilient one, and certainly they've not taken on the kind of debt that they did leading up to the internet crash in 2000 2001. And so this is like consumers are feeling really good about themselves. They feel very, very good about the national economy. And they're acting that way. That's why you've seen sort of kind of retail sales keep up and Amazon and everything else keep up. It's because we have an economy, we have a consumer who has a very good reason to feel good about themselves and do, at least on Main Street.
So Scott, in talking about the consumer, we've talked about kind of the tailwind that the Fed and lowering interest rates have been really over the last, call it 12 months now. I think this chart, more than anything, just puts it in perspective of how rates have changed globally from a central bank perspective over the last, call it 2 years. And I think it's really interesting to think back to maybe where we would have been January of 2019, coming off the back of basically a year's worth of hikes around the world, not just in the U.S. And remember kind of where we were and where we thought we were going from a Fed communication standpoint. And then to see that just reverse course as strong as it did towards the latter half of 2019, I think only added to kind of that consumer strength that we saw.
Yeah, and this is, these things just act, rate changes on the global central bank level, they act on the global economy with a lag. And so, in 18 we had, or in 2019, we experienced some of the lagged effects of the hikes that we got in 2018. And that's part of the reason why manufacturing had a little bit of a rough spot for some period of time. But coming into 2020, we're going to start feeling the effects of the very sharp decrease in global rates that we experienced on the back half of 2019. So that just all that is to say is that the global central bank activity, at least from a monetary standpoint, from a rate standpoint, is going to be a pretty big tailwind as we enter 2020, but it's not in the price yet.
Yeah, and Scott, you mentioned the idea of manufacturing. I think obviously we've looked at this chart in recent quarters to get a sense of how maybe the interest rate environment that we were in was putting pressure on the manufacturing sector. And I think you see that as we look back to the beginning of 2018, where things were generally positive around the world. What we're looking at here is manufacturing PMI numbers or purchasing manager index. So to get a sense for what manufacturing companies are going out to buy from a raw material perspective. And I think what you see again in 2018, beginning of 2018, things were generally green across the board, and it just got progressively worse for really the following, call it 21, 22 months. I think what you started to see, and the clearest way to see this is on the far right-hand side in the column, the world column, is you started to see a stabilization in the manufacturing space, which we think is positive. Now, again, full well knowing that maybe manufacturing makes up a little bit of a smaller piece of the pie today than it did, say, even probably 10 or 15 years ago. But this is another positive to add to the narrative that we've been talking about, both at the consumer level, but then also at the corporate level. So taking this and maybe then moving into just kind of developed economies and really economies around the world. Scott, we've looked at this chart in the past where we're looking at economic indicators. PMI oftentimes is included with those. What does this chart tell us about kind of where we sit and maybe how things should look going into 2020?
Yeah, I really like it. And probably obviously I like this chart because we show it, I think, about every dang quarter. But it's powerful because it gives you a good sense as to kind of what's going on in a very slow moving kind of macro framework. These are the three biggest economies in the world. So you got China in green, the U.S. in blue, and Europe in black. And these are leading economic indicators rates of change. So basically when it's turning up, that's a good thing for what's coming up next in terms of both economics and probably markets. And when it's turning down, it's the other way around. And what we saw in the first part, we saw it at China specifically, is in most of 2018, they were putting in pretty massive amounts of stimulus. Now that stimulus takes a while to take effect. But when China moves, they tend to move the rest of the world because now they're big, and they swing policy much harder and much more wildly than do either the U.S. or Europe. And so when China swings policy, it tends to move the rest of the world, but it just takes 6 to 12 months to actually start to get there. And so what we saw in the first quarter of 2019 is we saw China's leading economic indicators inflect upwards, meaning the trough had sort of been put in, at least on the China side, and it's starting to improve. And we posited that it would start taking effect in both the U.S. and Europe sometime in the back half of 2019. And lo and behold, as we enter 2019 or as we enter 2020, it looks like the U.S. has inflected upwards and looks like Europe's about to. When we get the next set of data, I'm pretty sure they will. But again, this is if we're talking about tailwinds here, and we have to a little bit in terms of the global central bank activity with respect to rates. Not to mention balance sheets, we can talk about that later. But rates certainly from a global central bank standpoint is certainly a tailwind as we enter 2020. But argue very strongly that this stimulus that's been put in place in China and elsewhere is going to act as a pretty strong tailwind as we enter 2020 as well.
So Scott, you talk about China and kind of being a leading economic indicator of other leading economic indicators in a sense. And this one data point that we've got right here, I think shows a pretty good picture of how Chinese economic activity has maybe turned the corner. Maybe explain this chart and give us some detail behind it.
Yeah, so I'll spend a second on this, but then probably the more important one's on the next slide, which is going to show more a global look at credit impulse. But briefly, credit impulse, all the credit impulse is describing the private credit creation in an economy relative to the size of that economy. It's relative to GDP or some other measure that you would want to use to measure an economy. And so what we're looking at is when it's green, that means that there is net private credit creation in an economy, and the magnitude of it is just how much is it. And so what in China, we saw in the end of 2015 and beginning of 2016, they put in a pretty massive stimulus both on the governmental and on the private side, and their credit impulse shot up. But it was a stimulus that was pretty fast acting, and it was a little bit sugar high like, and then they had to wean themselves off of that for most of the next 2 years. That certainly put a little bit of a damper on global growth. This go around, the stimulus that they put in was a little bit slower acting. It took us a little while to figure that out, that this is going to be a little bit slower acting stimulus. So it's taken a little bit longer than we at first anticipated, but it's finally getting there. And the fact that it's been a little bit slower acting means that we're hoping that they don't need to actually reverse course and reverse the stimulus like they did in 2017, 2018. But one of the important points is that it is actually starting to turn up now. So credit creation in China is again a positive just as we enter 2020. And on a global scale, that's what this global chart is. It's showing again the three largest economies, China, the U.S., and the Euro area, and the credit impulses for that combined entity as we move through time over the last decade or so. And what should jump out at you is the year 2018. So all three major economies have credit contraction. That has not happened since the financial crisis. There's always been some sort of offset. If one part of the world was contracting, the other parts of the world were expanding in terms of credit, and that was sort of keeping it in equilibrium. Well, 2018 was a pretty big deleveraging year on the private side. But what we're seeing in 2019 is that's to start to stabilize. It didn't turn sharply positive, but it started to stabilize. And as we enter 2020, that last little bar there doesn't even show the U.S. On it yet because the data have not come out. But when it shows the U.S., it's going to show a pretty big positive private credit creation in the United States for the fourth quarter of 2019. And it's going to just telling us that we've really turned the corner on the private credit creation side. That's another pretty big stimulus to global economies, another tailwind that we've got as we enter this year that again, I just doesn't feel like people are talking about this or seeing this too much yet.
No, that's really helpful, Scott. And I think we've done maybe a really good job kind of painting a picture for why we think things maybe are set to have a pretty strong 2020. I think now maybe let's transition to maybe what keeps us up at night, or what are we watching for in 2020 that's potential risks to the system. And I think this chart specifically tells a story around multiples, or if you think about price to earnings ratios, for example. Everyone always asks, how are markets valued? Are they overvalued, undervalued, fairly valued? And I think the case that we would make for today is that things are actually probably pretty close to fairly valued. But I think the interesting thing is when you look at what drives returns in equity markets. So you can make the case that generally speaking, either multiple expansion drives returns or earnings growth will drive returns. And what this chart shows is that the returns that we saw in 2019 were almost entirely driven by multiple expansion. So not surprisingly, you had multiple contraction in 2018 there, especially in the fourth quarter. And really you recovered most, if not all of that in 2019. I think what we're watching for as we head into 2020 is, do we actually get earnings growth heading into 2020? We're coming up on the beginning of earnings season from a corporate standpoint. That's what we will be watching for, specifically listening in to the Q&A sessions to get a sense for earnings growth as we get out into 2020, especially in the latter half. Are these companies expecting to see positive earnings growth again after maybe a tough year from an earnings standpoint that we experienced in 2019? So maybe that's one thing. Scott, the other thing that's probably on everybody's mind, or at least probably on every client's mind, and I'm sure they're asking advisors this question, is this idea around the political side of things in the U.S. So I think this chart gives us a picture of maybe a potential outcome in the U.S. Around the election, but maybe talk to this, and then we'll go through in a little bit more detail what that looks like.
Yeah, this is craziness. So FDR was a pretty progressive sort of fella in the 30s, and had some pretty large and shockingly large social programs that he put in place for the U.S. economy. And he looks like Reagan compared to Warren. So the sheer magnitude of the things that Elizabeth Warren wants to impose upon this economy in terms of tax increases is absolutely staggering. Now that being said, I'm not making a judgment, and I've never made a judgment on a call like this about the social, whether you think this is a good or bad thing for the United States from a social standpoint, but from an economic standpoint, from a market standpoint, is unambiguously horrific. So that is we talk about what keeps you up at night. Yeah, certainly something like this should and would keep you up at night. The silver lining, though, is that the market is currently saying there's somewhere in the neighborhood of a snowflake's chance in Hades that this actually happening. So what this chart is showing is two things. The red-green is the relative chance of either Biden or Warren getting the Democratic nomination. When it's green, the betting market is saying that it's Biden. When it's red, the betting market is saying that it's Warren. The yellow line is showing it's just a generic who's going to win the presidency. Is it going to be Trump, or is it going to be whoever the Democrat is? When it's going up as a Democrat, it's going down, it's Trump. See correlation? I do. Long story short, when the market is saying that it's going to be Warren getting the presidency, that line's going down. That's saying that she has no chance to beat Trump. When it's going up and Biden's going to be the nominee, it's showing it as being pretty much coin flip between Biden and Trump. But anything anything that would say that it's going to be a non-Warren Sanders nominee on the Democratic side is going to be met by the market with some exuberance, and might probably be a good thing, at least from a market standpoint. If it's Biden or Bloomberg, who's a pretty interesting fellow, or maybe even something like Buttigieg, that'd probably be that'd probably be a good thing. And if it's just basically, so long as it's not Warren or Sanders, the market will take this as be a good thing. So that those tax increases and the agenda, the Warren kind of Sanders agenda, would be a very scary and bad thing for the market. Right now, it is down to appear that that's being priced as a very likely potential outcome. But we're certainly watching Super Tuesday and watching these things pretty closely to get a better sense of it. We think we'll have a better sense of it come March the 4th. But it is something. It's certainly something that keeps us up at night right now.
Well, and Scott, maybe one question that we have gotten from folks already is, what decisions are we making, or how are we making allocation decisions today around the election? And I think it would probably be fair to say that it's still a little early to actually make decisions in your portfolio, as there's so many unknowns still out there.
Yeah, you just can't. I mean, like if you're positioning for the election today, then you're forgetting about Iran. You're forgetting about there's too much in front of us today to start worrying about the election. I'll tell you, just from a derivatives geek standpoint, it's in the Super Tuesday is in the options market, so it's in the volatility market right now as being priced. But it's not. But you think it'd be pretty hard for us to say there's really any pricing of it in the kind of cash equity prices or cash bond prices. Because it's just too far out, and there's too much other stuff in the way to get there before we get to that point. As we get closer, it will certainly start to become more real, but it's really tough to position a portfolio today this far ahead of and this far in advance of something. And there's so much other stuff out there that you need to be looking at and worrying about.
Well, and Scott, you brought up one thing that I wanted to touch on as well, is this whole geopolitics side of things, the Iran situation as it stands today. Maybe how does that impact whether it be our portfolios or just broadly the markets, and do we think that that's going to be an overhang, or do we think that that's going to pass quickly? What's that look like?
I mean, right now it looks like it's going to continue to pass quickly. That was our judgment upon it actually happening. We were out with some pieces about that, but it's because history has smiled upon those who have been able to see through Middle Eastern conflict. Middle Eastern conflict is nothing new. It doesn't tend to last all that long, but it certainly could be bad. But the odds were on the fact that it was this was going to pass reasonably quickly. And I will say that Trump yesterday in his 8-minute address was as controlled and intentional as I think I've ever seen him. He imposed a self-imposed Twitter blackout for like the previous 12 hours, which is got to be like monstrously difficult. So applaud him for his restraint on that. But he was really intentional. Like we basically they offered an olive branch of de-escalation, and we took it. So that was a really nice outcome for how this played out. I will say just two quick asides on that though. In terms of the ability for a conflict in the Middle East to actually stir things up from a global economy side is much different and much weaker today than it was even 10 years ago. And the reason for that primarily is due to the shale and energy revolution here in the United States. What I mean by that is that the marginal producer of oil in the world is now the U.S., now the shale guys. And so the world supply of oil is a much more geographically diverse set of suppliers than it was even a decade ago. And so just the ability for the global oil price to shoot up to $100 from 60 overnight because of something happening in the Middle East, it's just not there anymore. Because the shale guys will just turn the taps on and produce hand over fist as fast as they can. And that supply of oil will help keep a lid on how much geopolitics can impact the price of oil over the short run. So that's all we have.
No, I think that's super helpful. I think the question that we had gotten was around oil prices, and you hit on it. I think the spike, if you will, that we saw in oil prices was single digits. I mean, it wasn't anywhere near, it wasn't anywhere near the 50% spike that we used to see maybe 10 years ago.
No, and really, in order to get a negative impact on global economy out of an oil shock, you need like a 40 or 50% rise in the price of oil over a short period of time. There's just no way to get there now because of the shale guys. Like, it's just a different market than it was even 10 years ago.
Absolutely. So with that being said, that kind of does it for the prepared slides, if you will. Obviously, we've got our key takeaways here that we'll let everybody kind of take a look at. While we're doing that, I will remind you that we'd love to take any questions that you do have. We've had a couple come in that we'll address here. But again, 3 takeaways, if you will, is this fact that folks, whether it be the media or end clients, are thinking about the U.S. economy being late cycle. The data just doesn't necessarily suggest that currently. Partially, and I would say probably a lot of that comes from the fact that the U.S. consumer is in the best shape that they've been in for decades. And then finally, as we look out into 2020, the corporate earnings piece is something we're watching. Obviously, we talked about some of the geopolitics. We talked about the politics in the U.S. So there are definitely risks to the markets in 2020. We're not suggesting that there's not going to be any volatility by any stretch. But it's something that we're monitoring those individual items, but the backdrop for 2020 actually looks really positive. So with that being said, Scott, maybe the first question that came in, this idea of really kind of the Fed maybe stabilizing and staying out of the way, being on hold, if you will. Maybe how does that affect, whether it be Horizon specifically or just more broadly, the idea of fixed income allocations and asset allocation within the fixed income space?
Yeah, I mean, the Fed, I mean, what a round trip it's been for the Fed over the last 12 months. From a point last December of basically maximum confusion and just the communication effort on the part of Powell was abysmal in December of 2018 to fast forward 12 months and everybody understands what they're doing. Everybody understands why they're doing it. It's very clear about what kind of what the hurdles are and kind of what the expectations are for policy going forward. The guy grew up a lot on the job over the last 12 months, and it's to everybody's benefit. So one thing that is very clear now is that the hurdle to either raise or lower rates from here is rather high. And then the reason, probably a little bit beyond the scope to go into really detailed reasons, but I will say, kind of tease you with the fact that this idea of the policy framework change that the Fed has been evaluating for the past 6 months, past 12 months really, but formally for the last 6 months, this policy change they may be undertaking in order to shift how they view inflation, how they measure inflation from a very fundamental standpoint, is unabashedly dovish. It basically makes the case for raising rates really, really tough because of the past inflation misses that we've had. And so the chance that the Fed has to raise rates in the next 12 months is asymptotically close to zero. It's almost impossible to happen. Now, can they cut? Yeah, it's possible. We don't think it's very likely. Maybe once in 2020, depending on kind of where their view of neutral is. But it's probably the safer bet is that they're just on hold this year. And if they're on hold this year and inflation expectations are rather muted or kind of tame and just sort of where they are, which is what we expect right now, there's really no reason for rates to go much of anywhere. So we may get a slight steepening in the yield curve because global growth is picking up off the bottom, or off a mini trough. So you may get a slight steepening, but it's probably not going to be anything massive. So positioning wise, durations probably should be in the neighborhood of where your benchmark is, maybe a touch light, but just somewhere in the neighborhood. We continue to think credit is fine, but we're not adding to anything having to do with high yield or we're basically not adding to spread product right now. Spreads are really tight. We think they're appropriately tight. We don't think they're mispriced. The economy's in great shape. We're not going to get corporate defaults. It's probably fine to keep clipping higher coupons. But we think there's other places in the fixed income market to add risk if what you want to do is add risk. Converts and preferreds are two examples of places that we actually have been adding to recently, in lieu of adding high yield. We just think we don't think high yield is bad, but we just think there are better risk rewards out there to add risk in the fixed income portfolios.
No, that's super helpful, and that actually hopefully addressed another question came in around the are we seeing any stress in credit markets? And I think you hit all of those right there. I think maybe another question that has come in, and we've gotten this really for the past couple months even now, is with some of the things starting to maybe turn from a global economy standpoint, how's that affecting our allocation on the equity side from a domestic international perspective?
Well, towards the end of the last year, we increased our international allocations and across the equity suite of products that we manage, because we do think that this year is going to be one which the dollar comes up against a little bit of pressure to the downside. And if you do get a turn in the more cyclical parts of the economy, like the more manufacturing parts of the economy, it's actually good for places like Europe. It's good for places like Japan that are more exposed to the global cycle. They're more exposed to the industrial types of economies and sectors. I mean, think about this. The real simple example is like, name me a tech company out of Europe. There's no Googles, there's no Amazons, there's not like that. If you want tech, you have to go to the U.S. And it's part of the reason why the U.S. has done so well lately is because tech has been so dominant. But if tech is not going to be dominant, if the things that are going to be dominant are the more industrial sides of the world, and manufacturing types of sectors and products coming off of like really depressed valuations and really tough years, then you actually want to be in Europe for a stretch, or you actually want to be in Japan for a little bit of a stretch. Yen's also another place you probably want to be a little bit more exposed to if that's going to be the kind of economy and the kind of market that we get. And so those are some of the reasons why we did add to some of the international exposures that we had towards the end of last year. So far that's turned out to be a good decision, but it's something that we're obviously continuing to watch pretty carefully.
Well, and maybe to touch on something that you just brought up, the idea of maybe a tech underweight in Europe specifically, but let's bring that back to the U.S. And we've got a question talking about kind of the growth versus value tilt, maybe asking questions around kind of factors specifically. Low vol has had a really strong run, maybe experienced a little bit of stress there towards the end of the year, but how do we think here at Horizon kind of the growth value decision plays out as we head into 2020? And then from a factor standpoint, how do factors, whether it be low vol, whether it be momentum, play out as we go into the new year?
From the growth value standpoint, at least in the large cap U.S. space, we favor value a touch, but not a ton. We're actually pretty neutral on that right now. Like, we have more broad value exposure, but we have fairly concentrated tech exposure on the growth side. So it's a little bit barbelled, and it's pretty neutral right here for us in terms of the value growth. We do hear a lot of people out there talking up the value trade in the U.S. Don't think that's wrong-minded. It's just I think we think there's other probably higher probability ways to play that same kind of theme, and it's probably more in the international space for us. With respect to factors, yes, I mean, look, low vol had a ridiculously good first 3 quarters and had a challenging fourth quarter. And that if the global economy is turning and kind of PMIs are starting to turn back up, we would expect low vol to continue to probably lag broad market indexes, but not do poorly, just not be able to keep quite up, which is frankly what you tend to expect in low volatility. You don't expect it to keep up in an up 30 kind of year. It did last year, but that's certainly not the expectation for how that product and how that factor should perform in an up 30 kind of year. So we still think it's good. We just think it probably if we get a really strong year, we wouldn't expect it to perform like it did last year, which is exceptional. In things like quality and momentum, momentum is a little bit tricky because it certainly depends on what's been doing well recently, by sort of kind of definitionally. But it's right now it's a little bit loaded more with the low vol kind of things. As we move through the year, we probably started to get more on the momentum side. We started to like a little bit better. but we still do continue to like the quality factor. So, we do have some quality positions in the portfolio. We do still think that weathers well, because of the way that, this is still, well, it's not necessarily a fragile economy, but it's not going to be a 4% growth kind of economy. And so the quality types of companies we still think are going to be rewarded more so than just the broad market.
Good stuff. So, Scott, really appreciate your time this afternoon, and really appreciate everybody joining us. Happy to address any additional questions. Like I said, we got a number of them here today, but happy to address any additional questions offline as needed. And then obviously we'll have calls with each and every one of you as we go through the next couple of weeks, and we can address questions there, whether it be Horizon specific or just more broadly around the market. So really looking forward to those, and looking forward to connecting with each of you at this year, whether it's at conferences or office visits, or for that matter, events that we see each other at. So really looking forward to it. Appreciate, like I said earlier, appreciate the partnership that we have with each and every one, and really value those relationships, and look forward to a strong 2020. So with that, we will talk to everyone later, and hope everyone has a great rest of their day. Thanks so much.